Good morning, 8 o'clock, and everybody's here on time. What a change. Guess the buses are running today. No snow because it's middle of April probably when you're reviewing this. So easy to get here. Okay, parking's also good on the 8 o'clock class, so no excuses. Anyway, let's try and get started on chapter 11. So we did chapter 10, now 11, 12, that'll be it. All right, chapter 11 is differential and incremental analysis. A lot of thinking in this chapter. Hopefully not too deep, but you may find some of this interesting. It's lease and buy type stuff. Do we buy the equipment? Do we lease it? Do we close the department? Do we leave the department open? We did some of that with variable and absorption costing when we were analyzing things back in chapters, what was it, 8 and 9, I believe. Okay, so differential analysis. It's decision making requiring identifying key items relevant to consideration in the analysis of alternative actions. What does all that mean? Should I buy the equipment? Should I lease it? Should I close the department? Should I leave it open? Okay. What things are considered? Well, first, there's one that's not considered. Something called sunk cost. Sunk cost. Think of the sunk cost as a pizza oven. Okay, so we got a pizza oven over at Rocco's, down a block from Casey's on Gardner Avenue in Naperville. And we've got sunk cost, the pizza oven. And one of the people that work there has read in the magazine that there's a new pizza oven that cooks the pizzas quicker, cooks them better, the people love them, and it's going to cost $60,000 for the new oven. Should we buy it? Okay. The old pizza oven, this is the new one. New oven. The old oven cost $40,000. We've been depreciating it, and we've had $10,000 of depreciation. The book value is then $30,000. All right. It doesn't matter what we bought it for. It doesn't matter how much the depreciation is. It doesn't matter what the book value is. This is a sunk cost. This is a sunk cost. It doesn't matter. What would matter is if we could sell this oven. There's not really a market for 10-year-old pizza ovens. So if you took it out of the building and you tried to sell it, you put it on eBay or Craigslist, or you call the local restaurant association, anybody want to know, and they bid is $0. So the book value might be 30 grand, but you can't sell it. You can't sell it. None of this matters. What matters is when I buy this new oven, am I going to lower my cost and increase sales enough to justify the new expenditure? The only way any of this would matter would be if you found out you could actually sell this. Let's say you could sell it for 20 grand. If you could sell this for 20 grand, the new oven cost you 60. What does it really cost you? 60 minus the 20 you recovered from here. But again, this amount you originally paid doesn't matter. The only thing that's key are new items, the amount you could recover from the sale and the cost of the new one. And then any savings or incremental revenues that you generate from the purchase of the new oven. We'll do a couple of problems in a little while that'll hopefully make this clearer. So sunk costs are costs that occurred previously or historically that we don't care about in our incremental or differential analysis. They don't apply. All right? That's the definition of a sunk cost. What are considered? What are the items that are considered when you're considering to purchase something new or to lease it? New expenses, okay? Sometimes the new expenses when you buy that new machine will be lower than the old expenses because the new machine has been made in a more modern way. So instead of needing $600 a month of maintenance, like your old machine, it only needs $300 a month, okay? Or maybe it needs only $200 a month. So by buying a new machine, you're saving $400 a month, okay? Incremental, what's the difference? $400 a month cheaper, okay? How about revenues? When you buy the new machine, you're able to make additional product. If I'm able to make 10,000 more units and sell them all for a $2 profit, the extra 20 grand is what is important. The extra $2 of profit times the extra $10,000 units that I sell. The rest of the stuff doesn't matter. I'm selling 60,000 units now, I'm selling 70,000 later. What's important is the revenue on the extra 10,000, okay? It's what extra do I get from the new investment, okay? Avoidable costs are considered, okay? So maybe you're deciding to downsize, so your rent is cheaper. That would be an avoidable cost, okay? Maybe the new office spaces are in a building where there's a guard already provided. You don't have to pay for a guard. You've eliminated a cost. Another thing that people don't think of sometimes are opportunity costs, okay? What is an opportunity cost? An opportunity cost is something you give up. In other words, if I wanted to go open a barber shop, I wouldn't recommend coming to my barber shop for a haircut because I have no training in cutting hair. Even though a lot of my countrymen might. But opportunity cost says, if I wanted to go open up a barber shop, I would have to give up my salary at North Central College to do so because I'd have to quit this job, all right? So say I'm making 30 grand a year as a teacher, all right? And I could go become a barber, open up my own store, and after all the costs and whatnot, I make $50,000 a year as a barber. I'm only making $20,000 additional. So again, what do I care? I care about that incremental or the differential, okay? So if my new salary by running my own barbershop is 50 grand, the benefit is the difference, the 50 grand minus the 30, okay? So the incremental benefit to me is 20 grand. You consider those opportunity costs, okay? I'm losing out on that $30,000 salary. All right. I'm sure some of you are amazed that they actually pay me anything to do this. Anyway, one other item that you need to be aware of when you're doing incremental analysis are traceable and non-traceable costs. Sometimes there is a fixed cost that you know is required by a specific division or operating segment or department, okay? So maybe your department requires a guard. You have to have a guard for that department. The other department doesn't need one, all right? So it's easily to trace that guard's salary, his $30,000 a year annual fixed salary, to your department. Doesn't apply to the other department, okay? Other things are not easily traced, okay? The cost of the executive secretary to the president of your organization. Okay, it's not easily traced to how much of her salary belongs to each department in the company. Non-traceable costs do not figure into the contribution margin of your department. Traceable costs, even if they're fixed, will come into play. And we'll see that in a couple of examples shortly. All right. Again, common occurrences where we're using differential and incremental analysis, lease versus buy, discontinuation of a business segment. Should we manufacture the parts for the product in-house, or should we buy them from a supplier? Okay. Replace fixed assets, like the pizza oven example. Should we sell something or process it further? What do I mean by that? Lumber, trees come into the back of your manufacturing plant. We cut the bark off, we slice them up, and we have some planks. We might be able to sell the planks for $20 a piece. On the other hand, if we took the planks and did more manufacturing, trimmed them up and made them 2x4s, maybe each plank would turn into two 2x4s. Each 2x4 could be sold for $15. So instead of selling one plank for $20, we're going to make two 2x4s that we can sell for $15 each, which means times 2 is $30. Incrementally, we're adding $10 of sales. When would we consider doing this? When the cost of the extra manufacturing to convert the plank into a 2x4 is less than the $10. So if it would cost me $4 more to turn one plank into two 2x4s, I get $10 more in sales. I have to spend $4 extra in manufacturing costs, so I'm ahead $6. Okay, then I would do it. If it cost me $12 of manufacturing costs to turn a plank into two 2x4s, I'm incrementally adding $10 of revenue and $12 of cost. Don't do it. Okay, it's that simple. All right. The last item are special orders. Special orders, you generally sell a product for $18 a unit. Okay, whether it's online, at your own website, or if it's at a retail branch of yours, you're selling them for $18 a piece. And someone calls you up and says, I would like to buy 2,000 of those widgets, whatever you're making, but I would only pay you $15 a piece. Okay, what you now need to do to decide if you want to do it is first, make sure you're not jeopardizing your own sales. So often you want to know, maybe you're operating in Illinois and this is a supplier in California. So you don't do any business in California, you check your website sales, you barely have any sales going out to California. You pretty much are selling in the Midwest, even on your website. So those units that this person's going to buy are going to be sold exclusively in California, so it won't cannibalize your existing sales. Remember, mutually exclusive, okay, versus independent. This would be an independent decision. If you do it, it's not going to cannibalize your sales. If it would be mutually exclusive. You couldn't do one without harming the other. So if we decide to sell this person some units at $15 each instead of $18 our normal retail price, number one, we would have to have enough capacity to do so. So let's presume we have enough capacity to make some extra units. So we talk about it, and in the end we decide to sell them 2,000 units at $15 a piece. The reason we would decide to do it is all the variable costs associated to make these equals something less than $15. So if our variable cost to make them is $12, then we could go ahead and sell them some at $15. We're going to make $3 extra. Okay, we sell them at 15, it costs us variable cost $12. That's a $3 profit. When we're talking variable costs, our direct materials are direct labor. Okay, variable manufacturing and variable selling and general administration costs that we know apply to the product add up to $12 a unit. We could sell to them for 15, we're making $3. Yes, it's not helping reduce fixed costs, but we're not worried about that in this situation. The rest of our business is covering our fixed costs. All right? So special product pricing is the final category. We're going to do some problems that will hopefully enlighten you on the process of doing this analysis. Okay. Before we get into some of those problems, let's take a look at two items here. Targeted costing and cost plus. We saw some of this in chapter 10. All right. Cost plus, when we were figuring out transfer pricing between departments, sometimes you add a margin from one department as you pass it along to the next. Okay, so here we're going to sell a product to retail. All right, if we figured out that the cost of the product, all in, all the variable and fixed costs figured out, it's costing us $22 to make this here product. If our CEO has dictated that we want a 25% margin on all products, the cost of the product will determine the selling price. So we'll take that $22 cost and multiply it by 1 plus the margin that we desire and get $27.50. We now know the selling price. That's cost plus pricing. Figure out the cost of the product, multiply it by 1 plus the margin desired, you get a selling price. Remember, questions, send them in. By the way, I should also point out that when you send in a question, expect a reply from me. So look back online for the answer, okay? All right, that's cost plus. Let's look at targeted costing. Targeted costing is based on what the product costs you also, in a way. Here, what they do is first they look at the marketplace. So you're going to sell a product, and let's say it's a dozen roses. You're in a flower shop, and you want to figure out what you should be selling and how much margin you should get when you sell a dozen roses. And so you make some calls and you look online, and the competitors in your area are selling a dozen roses for about $40. So what do you think? Are your roses premium? No. Are they not as good as a competitor? No, you think they're just about as good, so you're going to price them in line with the competition. Okay, remember your economics class? This is a common product. You're going to end up getting the price that the market will bear. The market's already told you $40 is the appropriate price to sell a dozen roses. However, you have your own policy. You will only sell products where you can get a 21% margin. So now you take the $40, and this time you divide it by 1 plus the margin you want. 40 divided by 1.21 comes to 33.06. So that dozen roses, boxed with a vase and delivered, have to cost you 33.06 or less. So what do? You figure out, what does the vase cost me? The vase costs me $4. What do the flowers cost? The 12 roses cost, what do we got? $4 there, and we're looking for 33, so maybe the 12 roses at $2 each, that's $24. All right, and you got some packaging and a card that you put in there, and those cost $2. So we're up to 28, 30 bucks, and then it costs you $5 for shipping. 28, that's $35. $35 is greater than $33.06. This doesn't work. So what do? We have to go back to work. We need to shave $2 off this cost. We call up the person that's supplying us the roses. Any chance we could get these a little cheaper? And you haggle back and forth and you say, well, I know I've been normally planning on ordering 1,000 a month when I called you. What if I doubled it and I bought 1,500 a month? They go, if you're gonna buy 1,500 a month, we'll give you a better price. We'll give you $1.85. Okay? So now what do I gotta figure out what $1.85, get your calculators out, help me out. 1.85 times 24, no, times 12. 185 times 12 equals 2220. 2220. So now where am I at? 4, 9, 11, 3320. I'm close. I'm close. So maybe I make a call here and I get these people to give me a break on the pricing there. And we talk them down to $3.85. All of a sudden, doesn't cost us that anymore. It's costing us our $33.05. That is the process that occurs when you use targeted costing. What are you targeting? You're targeting the cost. You know what the product has got to sell for because the marketplace is telling you. Marketplace is telling you, if you tried to sell these for 42 bucks, no one would buy them. They'd all be online buying them at 40. Okay? If you tried to sell them cheaper, at 38, you'd have a line out the door, you'd have to hire extra people and pay overtime. You're gonna have to raise the price. 40 bucks is what the market's saying it's gotta be. If it was 40 bucks and your original costs were 35, that exceeds the 33. We gotta somehow work that 35 bucks down to 33. So let's figure it out. We knocked 15 cents off a rose, we knocked 15 cents off the vases, and we got down to $33.05. We're in business now. That's targeted costing, all right? You don't change the selling price because the selling price is determined by the marketplace. Well, if you didn't write this down, I'm sorry, just back up the video. All right. The last item. Oh, I take that back. There's two more items. Bottlenecks. All right. I know we've asked this before. None of you have been in a factory, I don't think. You should take the Lagunitas tour down in Chicago, off Ogden Avenue near Damon. You guys like breweries. It's a great tour. It's free if you're 21 and older. I think they give you 4, 5, 6 samples of beer on the tour, which lasts about 45 minutes. And they got a nice brew pub there also. That you have to pay for after the tour if you want to stay there. It's actually was pretty good food. But if you want to see a factory in action, go during the week when they're open for their free tour. You got plenty of time now, okay? Lagunitas in Chicago, all right? It's a good brewery factory tour. But anyway, what happens in factories is you'll see a bottleneck, okay? So maybe one machine is really expensive, so you only have one of those machines, whatever it is. So again, product or raw materials is coming into your factory, all right? And you've got station one, some work's being done here, and then it gets sent to a couple of different places, station two or station three. Maybe there's two station two station two machines. So half the product goes here, half of it goes here. They do whatever they need to do, and then it all ends up over here at station three. Okay? Bottleneck. All of this comes into this machine. It takes a longer time to do. Okay? All right. Maybe you've got a couple of different products, and some products need more work at station three. This is what we're going to look at here. That's what bottlenecks are. All right? The problems will hopefully clear this up. All right, so if you open your book, we're going to go through some problems. We're going to do some of the assigned homework problems. There were a lot of them. We're going to end up doing close to half of them. Most of them are short, so they shouldn't take too long if we understand the concept. All right? So the text, page 543. All right, we're going to start with 11.1, which means you can do 11.1. I think it would be good if you did it on your own. You already have the answers to them under the learning module tab on Blackboard, so you can have these printed out already. So pause the video, go print them out. Okay, back. All right, so you've paused the video, we've restarted it. You've got my Excel sheet with the answers on how to do these in front of you. I'm going to also turn them on Blackboard here. I'm on the learning module here. I've pulled them up also. Hopefully we got you wide awake. Now we'll put you to sleep. So again, you can follow along. You might have this printed out. You might have it on a window on your computer screen. All right, 11.1. What is it telling us? This is a lease versus buy. We own the machine. We could lease it out, okay? We could lease it out and collect some revenue, or we could sell the machine, all right? We've done our analysis. We can sell the machine for $90,000. We're going to have to pay some broker 6% commission. So we sell it for $90,000, pay a $5,400 commission. We're left with $84,600 in our pocket. Okay? Alternatively, if we don't want to sell it, we have another opportunity that's presented to us. Someone offers to lease it from us for 4 years. 4 years of lease rental, 25 grand a year, let's say, is 100 grand over 4 years. When you lease it to them, there's some lease costs, such as maybe you have to have insurance on the product. Maybe there's some maintenance that you guarantee to do for them. Those costs over the 4 years add up to $9,000. That's what you're expecting. So you could lease it to someone for 25 grand a month in lieu of selling it to somebody, pay some maintenance and insurance and other costs, and end up with $91,000 in your pocket. So what should we do? According to this analysis, I'd rather have 91 than 84,006. So we'll lease it. I'm $6,400 ahead. Now, some of you, if you're in my corporate finance class, would say, but this doesn't consider the time value of money. You're correct. Chapter 12, we'll look at time value of money. For right now, these problems, we're not going to worry about it. We're basically in a zero interest rate environment, so they're not worrying about the interest rates. Real life, you need to worry about the interest rates. But here in accounting class right now, we're going to ignore them. We're going to say if the nominal values, we're going to go with the option that presents us the best opportunity. We're going to lease this for 25 grand a year for 4 years, pay 9 grand to maintain the machines, take in 91. That's better than just selling it, paying a commission and getting the 84.6. So the answer to 11.1, lease it, make $6,400 extra. Questions? Gets us to 11.2. All right. Oh, I don't like that. I'm going to have to change it. I'm going to spell difference wrong. Shouldn't have mentioned that. I should have just edited the video. Too much work. All right. Oh, and it's still spelled wrong. That looks better. Okay. We got piece of equipment that can be purchased. This time we're the one that's purchasing it, so we're on the other side of the transaction. We can purchase a piece of equipment for 120 grand today. It happens to be out of state. They're going to charge us $1,500 to deliver and install it. Oh, by the way, another incremental cost when you buy machinery, maintenance. It's going to cost us $2,200 a year to maintain it. This machine is going to last us 6 years. Okay? 6 years of $2,200 each is $13,200. Okay, you guys have this, so if you're at home, you can hover over the 13,002 and see the formula that I got in there. E15 times F15. All right? I got the $6 hanging off over here. 6 times the 22 is the 13,200. So what is the cost to purchase the equipment? 120 to buy it, 15 to deliver and install, 13,002 to install. For maintenance for 6 years, that's 134,700. Alternatively, we can lease it. Pay 25 grand a month for the same 6 years, that's 150 grand. Do I want to spend 150 grand and lease it, or do I want to buy it and spend a total of 134,700? Again, excluding financing costs, buy it. I'm saving 15,300. That's a lease buy problem, okay? You'll have another couple of lease buy problems to do it somewhere along the way on the assigned problems. Gets us to 11.3. All right, we start out with an abbreviated partial operating income statement. Sales minus cost of goods sold give us a gross profit. We've got some operating expenses. When we subtract that, we have a loss. We've done these before. Should we close the department? That's differential analysis. If we close this department, it's part of a conglomerate. There's other divisions and departments making other products or servicing other, having other service revenue, whatever it is. This department, if we closed it, this is the incremental column. If we closed it, we would not get 15 million in sales. That's a change. We'd lose 15 million in sales. What about cost of goods sold? They tell us 70% of this number is variable in nature. The rest is fixed. So we would get rid of this 70% of this variable. The fixed stays there. It's just going to get allocated to another division. Okay? So you only eliminate the 70% of cost of goods sold that's variable. So that's a plus to us. We don't have to spend that $7,560,000 of variable costs. Then it tells us operating expenses. 75% of those are variable, 25% are fixed. The fixed remain, they'll just get allocated to other divisions. So what do we escape? We escape 75% of the 8 million because 75% was variable. So we lose out on 15 million in sales. We reduce our variable cost of goods sold. We reduce our variable operating expenses. Net impact, we're $1,440,000 worse off. Don't close the department. It's contributing to reducing the overall fixed cost of this conglomerate. This is negative, do not close. How did we get this? We just start with what was given. If we close the whole department, we lose all the sales. We reduce our expenditures. 70% of this is variable. So when you don't have the volume from the sales, you don't have the variable cost of goods sold. When you don't have the volume from the sales, you don't have the variable operating expenses. Those disappear. This negative, those plus, we are in the hole. Don't close that department. It's that simple. You've done these before. Before, we might have created an entire variable costing income statement. You could do that, you'll come up with the same answer, but since this is the incremental or differential chapter, we just look at the things that are different. Okay? Gets us to 11.6. Same concept. We're given an income statement, all right, or an operating income statement. If we close this department, they were nice here. They split the variable and fixed cost of goods sold in the book, and they split the variable and fixed portion of the operating or selling general administrative expenses. They're telling you which is which. So what happens if you close this division? You lose the $280,000 in sales, but you don't have to pay the variable cost of goods sold. You still have to pay those, so that's not a difference. Variable selling general administration, we avoid. That's a positive for us. We still pay our fixed SG&A. Just another department it'll get allocated to. If we give away $280,000 in sales, and these are the two variable costs that we avoid, that's $235,000. That does not offset the $280,000 in sales. We will be $45,000 worse off if we close. Do not close. Okay, hopefully 11.6 makes sense. Again, send me an email. Okay, send me a shout out. Any questions that you have, I will try again to write the question down. I won't say who sent it to me. Okay, and then I'll answer it, but I'll answer it to all of you. Okay, because I know some of you don't like to ask questions, but you might benefit from one of your peers' questions and my answer, hopefully. That was 11.6. And we have 11.9. Let's get 11.9. Let's try and get 11.9 on one page. Almost there. Edit. Okay, we got this one page. Perfect. 11.9. We can buy a new machine. This new, more modern machine only costs us $24,000 a year to operate. Uses less oil, needs less stoppage time, whatever it is, it only costs us $24,000 a year to maintain. The old machine, recoverable cash from this old machine is $250,000. We don't care what we originally paid for it. We don't care how much depreciation. We don't care what the book value of it is. Those are sunk costs. What do we care about? Can we sell it and get some money out of it? In this case, we can. We could get $250,000 out of that machine if we sell it. If we keep it, we got to keep paying $72,500 a month to maintain it. So we can start to see why you might be interested in buying this machine, okay? Because you're going to dramatically eliminate maintenance costs. Okay, so what do we have? We have $550,000. We are going to save $48,500 per year. In 8 years of that 48.5 gives me $388,000. All right. Since you get $250 from the sale of the old machine and save $388 over 8 years, in total that's $633,000. If I could save all that money by selling this machine, I'm going to get $250,000 in cash. I'm going to save $388,000 in operating expenses. I'm going to buy the new machine. Ignoring financing cost again, we're better off $88,000. Questions? Okay. Out of pocket, when I buy this machine, I'm only going to take $300,000 out of my pocket. I'm going to pay $550,000, but I'm going to get $250,000 by selling the machine. I took $300,000 out of my pocket, but I'm saving $388,000 in maintenance cost over the same time period. That's $88,000 better off. Buy the machine. That was 11.9. All right, this is 11.15. They tell us with the direct material labor, the factory overhead, the SG&A, all that adds up to costing us $143 to make every unit. We're selling them at $200. So far, that looks like a pretty good thing. We're selling something at $200, it costs us $143. We're making $57 a unit. All right. Someone calls up. So this is a special product pricing problem now. They're willing to pay you $150. Okay, they're willing to pay you $150. Now, right on, at first blush, that's probably a good deal because it's more than what's costing me already. So I probably want to do this. But let's see how good it is because they tell us a few things. We're going to spend the same amount in direct materials, same amount in direct labor, okay? But here's where some of the incremental comes in. All right? We don't have to add to our fixed cost. We do it for every one of the new units. What did they want? 100? Was it 100,000? Oh, I got another typo in there. I'll fix that. For every one of the 100,000 new tires that you're selling, there's $75 of material, $20 of labor installed. We don't need to buy more equipment, okay? So we don't have to increase that fixed component, all right? But we do have some variable. They're telling us 70% of this was variable. That's 21 bucks. The SG&A in this problem, they made really complicated. They're telling us the new SGA is 60% of the old SGA because only 60% of this is variable. Plus shipping, okay, so we got to add some shipping, $3. So we were at $18. All right? So new SGA is 60% of old SGA. So 60% of this is 6 and 480. Let's make sure I get this right. Double check me, please. 18 times 0.6. I've got 1080. All right. If I'm double check and make sure I get this problem right. 11, 14, 11, 15. Oh, they pay a 3%. 3% commission is what was included in SG&A before. They don't have to pay that anymore. So we're saving $6. Okay? Minus $6 of commission. But we have to pay shipping of $3. And we have to spend $400,000 to be approved to sell this product to this company. If we're making 100,000 new tires and we got to spend 400,000, that is an additional $4 from that fixed cost that we're adding. What did they call that? A certification fee. That's good. That should all add up to our 1180, which we have right here. Tried to explain it here also. So we have 1180 in SG&A. Now we can add up. The product now costs me $127.80. So this special order is going to cost me $127.80 a unit. I'm going to sell them for $150. That's good. That's $22.20 profit per unit. They explain in this problem that you're selling them internationally, I believe, so you don't have to worry about them cannibalizing your U.S. domestic sales. You're glad to do this. Those extra profits at $22.20 come out to $2.22 million of profits. Do the deal, sell it to them for $150. Hopefully that makes sense to you. And what do we have after 11:15? Oh, you should be happy. We only have one more problem. 11:21. 11:21. They tell you there's 3 products: small, medium, and large. This is the bottleneck problem. Okay? They're telling you you need 3 units of bottleneck here, 2 there, and 1 there. Okay? How do they describe it? Let's see. Hours. You need to work 3 hours here, 2 hours on this, and only 1 hour on a small unit. Okay? So all we do is go to the contribution margin. We're actually doing part B ahead of part A. If it's generating $54 of contribution margin, but it takes me 3 hours on the bottleneck machine, I'm earning $18 of contribution margin per the bottleneck. Okay? 54 divided by 3. 40 divided by 2 hours, $20. You're getting $20 of contribution margin pumped into your company for each one of these that you're making, right? Per hour. 24, 1 hour is 24. This is the best one. So what are they asking you? If you wanted to devote more resources, you wanted to go sell more product, do some advertising, sell some more of the small ones. They don't take up very much of your bottleneck issue at whatever machine is causing. Every extra one you sell is going to contribute $24 per hour to contribution margin. If you sell more of these, you're only getting $18 more per hour of contribution margin. This is the best unit. It's not to say that they might not all be good and all profitable. This is the best. That's what we're identifying here with this bottleneck problem. All right, we got it all on the screen now. We come back, they tell you make 3,000 of each. We know the contribution margin. So if we multiply the units times the contribution margin, we know what our contribution margin total is for each of the large, medium, and small product. If we add those three up, we get 354,000. That's the total contribution margin from our three different products. It told you there were $85,000 of fixed costs that we cannot trace to any of the departments specifically. Since we can't trace it directly to a product or a department, it comes out at the company-wide level. So we have contribution margin for all the departments equals 354, then subtract the 85, and you get 269. You now know what the operating income is for the combination of the small, medium, and large product. It's 269,000. Non-traceable comes over here. If they were traceable, you would have subtracted some here, and some here to get a contribution margin for each, okay? These are non-traceable. That's all there is to it, is knowing how to set it up. Bottleneck problems should be relatively easy, all right? You're gonna have to be able to calculate or be given the contribution margin, and you're gonna have to be told what the bottleneck is. Simple division, and you get which one is the best. That's all I can do for you for chapter 11, other than to remind you that yes, this was already on the learning module tab, so you could print it out. You could look at it on your laptop. You could probably pull it up on your phone, wherever you're hanging out. Hopefully, this is making some sense to you. All right, it's a tough situation doing this online learning, but it's what we're left with. Again, I am around campus most days. You know, if we really have to meet, you know, one of you could sit way back there in the corner and I could still be up here. We could be 30 feet away and we could figure something out. But in the meantime, send me an email, 10, 11, 12, that's it on the final. Forget doing, I think on the notes it had you have to do a page for chapter 14, forget that, we're just doing 10, 11, 12. I like 12, it's capital budgeting. If you're in my finance class, piece of cake for you. That is, if it was a piece of cake for you in the finance class. I'm tempted to actually just have you guys look at my corporate finance video. Might save me. But I won't, I might add it just to give you an extra perspective, but we will do some problems. I'll post those on. I'll post a video for chapter 12. The next thing will be after you guys do your homework and submit them and get your credit for chapters 10, 11, and 12, I'll put together a practice exam. I'll send that to you. I'll send you the answers. If we understand it and we're all good, we're good. If I need to do a video to go through the problems like we did today, I don't have a problem doing that, okay? Let me know. Let me know if these videos are useful to you. I'm hoping you're learning something, okay? If you peeked at this before Thursday's test, back in the future, don't spend the time on this. Go back and study for the other test. All right, have a good day.